Welcome back, everyone, to our third session. Today, we're going to take a major step forward in understanding how financial markets really work, starting from the moment a company decides to go public and stepping into the world of trading, regulation, and modern market dynamics. Let's begin by understanding a foundational distinction in financial markets, the difference between primary and secondary markets, and how companies become public. When a company decides to enter the stock market, often referred to as going public, it means that it's becoming a publicly listed, publicly traded, or publicly owned company. These are interchangeable terms. The very first time a company offers its shares to the public, it does so through an initial public offering, or IPO. Now, what happens if a company is already listed and wants to issue new shares? Let's say Microsoft is already public but wants to raise additional capital by issuing more stock. In that case, it uses what we call a seasoned equity offering, SEO. The company is already known, already seasoned in the market, and is now introducing new shares. Whether it's an IPO or SEO, this process is typically managed by an investment bank. Institutions like Goldman Sachs or JP Morgan have entire departments dedicated to this, known as investment banking divisions. They approach firms, help them with valuation, produce regulatory documents like the prospectus, and liaise with regulators. In the US, the regulator is the Securities and Exchange Commission, SEC. Once the prospectus is approved or gets its visa, the IPO can move forward. Let's explore what happens behind the scenes of this process. When an investment bank leads an IPO, they sometimes take on what's known as an underwriting role. This means they commit to the success of the IPO. Even if no investors show up, the bank agrees to buy unsold shares themselves. That's called a firm commitment. Underwriting is often done in groups, called syndicates, led by a primary investment bank and supported by others. For example, JP Morgan might lead, and several others will take part of the offering. The ultimate goal of an IPO is to attract demand. The measure of that demand is oversubscription, when more people want to buy shares than are available. If an IPO is 10 times oversubscribed, it means investor appetite far exceeds the supply. That's usually a bullish signal for the company's stock in the days after it goes public. Now, not all companies are public. Some remain private, what we call private firms or private corporations. These firms are not listed, and that brings both benefits and limitations. One benefit is privacy. Private companies are not required to disclose quarterly financial reports, making them less transparent, which, from their perspective, protects business-sensitive information. However, this secrecy also makes their stock less liquid since it's not traded publicly. Private placements often use exemptions like Rule 144A, which streamline the issuance process and reduce costs compared to a full IPO. However, that cost saving comes at the price of limited liquidity. Let's now shift to some more innovative approaches. A more recent development, particularly popular in the 2000s, is the rise of SPACs, special purpose acquisition companies, which is essentially a financial shell company created with the sole purpose of acquiring a private firm. Large investors, usually private equity firms or hedge funds, raise money in the SPAC without revealing their acquisition target. Investors back the SPAC based on the sponsor's reputation and track record. Once the SPAC is funded, it has a set period, often 2 years, to find and merge with a target company. If it fails to do so, it returns the money to investors. Some SPACs guarantee a hurdle rate, a minimum return, while others simply promise to return the NAV, net asset value. Now here's the twist. When the SPAC merges with a target company, that target effectively becomes public. So SPACs provide a faster, cheaper route to public markets compared to traditional IPOs. Now that we've covered how companies get into the market, let's shift to how financial assets are actually traded. There are four broad types of markets. One, direct search markets. In a direct search market, buyers and sellers find each other directly. There's no intermediary. Think of platforms like Craigslist in the US. Someone wants to sell a couch, someone wants to buy one. You connect directly. While this kind of market is rare in financial services, it's a helpful concept for contrast. Two, broker markets. Here, brokers act as matchmakers between buyers and sellers. You don't deal directly with the other party. The broker helps you find them. Real estate is a classic example. You can go directly, but most people use brokers. In finance, stockbrokers play this role. They don't buy or sell from their own account. They just connect you to others in the market. Three, dealer markets. This one's different. In a dealer market, the dealer buys and sells directly to you. They quote both a bid, buy, and ask, sell price, and profit from the spread between them. The best example here is the foreign exchange market. When you go to a bank like BIAT to buy dollars, the bank is acting as a dealer. It buys low, sells high, and earns money on the difference. Fourth, auction markets. Finally, we have auction markets, the most common in public securities. In these markets, buyers and sellers submit their orders and the system matches them. This is how most stock exchanges function. The Tunis Stock Exchange, the New York Stock Exchange, and NASDAQ all rely on auction mechanics. Price discovery happens through supply and demand. The matching of buyers and sellers creates the market price. These auction markets are considered highly transparent because the price formation is visible and accessible to everyone. Let's now talk about how you can participate in these markets. When you trade, you don't just choose what to buy, you choose how to buy it. This is where order types come into play. Market orders. A market order means you accept the current market price. You just want to execute now. If you're buying, you lift the offer. If you're selling, you hit the bid. This is fast, but it comes with a cost. You give up price control. If the bid-ask spread is wide, you might pay more or sell for less than expected. In liquid markets like US tech stocks, spreads are tiny. This isn't an issue. But in thinner markets, like some Tunisian stocks, crossing that spread can be expensive. Price contingent orders, these give you control over the execution price. Let's break down a few key types. A limit buy order says, buy only if the price falls to this level. A stop buy order says, buy if the price climbs to this level. You're entering as momentum builds. A limit sell order says, sell only if the price rises to this level. A stop loss order says, if the price drops to this level, sell immediately to cut my losses. Traders use stop losses for risk management. For instance, you might decide, if my stock drops 10% from my entry price, I'm out. That's a stop loss strategy. Just remember, limit orders give you control, but no guarantee of execution. Market orders give you execution, but not control over price. You'll soon see this in action with your trading project. Now let's dive deeper into the technology and structure behind trading. Over-the-counter OTC markets, they operate without a centralized exchange. Dealers, usually banks, quote prices and make markets. You'll see this in action if you try to buy or sell foreign currency through BIAT, for instance. ECNs, electronic communication networks. Most modern markets now operate as ECNs. These are electronic platforms where buy and sell orders are matched. The Tunisian BVMT exchange, like most global exchanges, uses this model. In ECNs, everything is automated. Buyers and sellers enter their orders, and the system finds the match. Price discovery happens digitally. Specialist markets. Historically, some exchanges, like the New York Stock Exchange, relied on specialists or designated market makers, DMMS. These individuals specialized in specific stocks and helped maintain liquidity. Today, most of this role is handled electronically, but some DMMs still exist, especially in less liquid markets. The trading world has become deeply interconnected. The New York Stock Exchange, NYSE, NASDAQ, Euronext, and other major exchanges have undergone waves of mergers and acquisitions. Market access varies depending on your level of access. Level 1, you see the best bid and ask prices. Level 2, you see more depth, multiple bids, offers, but can't trade. Level 3, full access, typically for large banks or professional traders who can place and manage orders. As markets became more complex and competitive, algorithms entered the scene and changed everything. Algorithmic trading, this refers to using computer programs to execute trades. A human designs the strategy, but once deployed, the algorithm monitors the market and reacts automatically. One common strategy is called pair trading. It relies on the idea that certain stocks move together, statistically. If one diverges from the other, the algorithm sells the overpriced one and buys the underpriced one, expecting them to converge again. This isn't just speculation, it's based on rigorous statistical relationships. You'll hear terms like co-integration, which you'll study in econometrics, or time series analysis. High-frequency trading, HFT. High-frequency trading is a subset of algorithmic trading. It uses extremely short-term data, sometimes reacting within microseconds. Firms that engage in HFT often place their servers physically close to exchange infrastructure just to gain a millisecond advantage. That fraction of a second can mean the difference between profit and loss. Dark pools. Dark pools are private trading venues where large blocks of shares are traded without revealing details to the public market. Why? Because large trades can move the market. Imagine you want to buy 5% of a company. If that's visible on the open market, prices will rise before you finish buying. In a dark pool, your identity and intentions remain hidden. In Tunisia, we do have block trades, though not full-fledged dark pools. These are handled in short windows, often after the official trading session. So, algorithmic and dark pool trading may feel far from the retail world, but they're shaping the broader environment you operate in. Trading isn't free, and your goal as a smart investor is to understand all the costs involved. Explicit costs. These are the visible ones, like brokerage commissions. In Tunisia, commissions typically range between 20 and 80 basis points, 0.2% to 0.8%. If you don't negotiate, you'll probably pay the higher end. With good relationships or volume, you might get closer to 20 BPs, which is what professionals aim for. Implicit costs, less visible, but just as important, is the bid-ask spread. If you buy a stock at 100 dinars and the next bid is 95, that 5 dinar gap is an implicit cost. The market needs to move by at least 5% before you even break even. So, when choosing what to trade, consider not just the upside, but how much the market structure itself can cost you. Let's say you have 100,000 dinars. You want to trade more than that. This is where buying on margin comes in. When you buy on margin, you borrow funds from your broker to amplify your position. So with 100,000 of your own money, you might buy 200,000 worth of stock. If the stock goes up 10%, that's 20,000 profit, a 20% return on your capital. But margin cuts both ways. If the stock goes down 10%, you lose 20% of your own capital. Key terms: initial margin, what you must deposit to open the position. Maintenance margin, the minimum equity you must maintain. Margin call, a demand to deposit more funds if your position falls below maintenance level. This concept is core to futures markets, which we'll explore later. For now, just know that margin gives you leverage, and with leverage comes risk. In Tunisia, margin trading is not allowed, so this remains mostly theoretical, but very relevant globally. So far, we've assumed you're buying low and selling high, but what if you think a stock is overvalued and want to bet it'll fall? That's where short selling comes in. Here's how it works. You borrow a stock, say Microsoft, from a broker. You sell it immediately, let's say at $20. Later, the stock drops to $18. You buy it back, return it to the broker, and pocket the difference. That $2 is your profit. Short selling allows investors to profit from price declines, but it also comes with unique risks. If the stock price rises instead of falls, losses can be unlimited. In Tunisia, short selling is not permitted. You can only go long, meaning you buy stocks and hope they go up. Some investors replicate a short exposure using credit default swaps, CDS, or put options, but those are more advanced tools and often not accessible to the general public. Financial markets don't operate in a vacuum. They're heavily regulated. In the U.S., the main authority is the Securities and Exchange Commission, SEC. In Tunisia, it's the CMF. Key regulatory acts in the U.S. include Securities Act of 1933, focused on disclosure in IPOs, Securities Exchange Act of 1934, oversight of trading markets, Sarbanes-Oxley Act 2002, introduced after major scandals like Enron to improve transparency and accountability in financial reporting. Insider trading. This refers to trading based on private, non-public information. It's illegal and can lead to prison time. Even if you're not the one trading, but you pass private information to someone who does, that's still insider trading. Company executives, board members, and even accountants must disclose their trades to regulators. There are blackout periods around earnings or major decisions where they're not allowed to trade. In short, trading on public information is fine. Trading on secrets is not. As we close this session, keep this in mind. The more you understand the rules of the game, the more confident and effective you'll be when it's your turn to play.